Our next guest says Netflix's ad tech scaling should scare the legacy TV landscape. Let's get more on the quarter from LightShed Partners co-founder Rich Greenfield. Rich, great to have you with us.
Thanks for having me, Melissa.
You and a lot of other people have been really bullish on Netflix for quite some time, saying it's basically Netflix's world. Everybody else is living in it. Has anything changed with this quarter? Does it put it even more in the lead, for instance?
I mean, look, they're producing content in 50 countries. They're buying back. I mean, they bought back $3.5 billion of stock. They raised price again. No elevation in churn, even in a weaker economic environment. We forget about the tariffs and everything that you've been talking about for the last few weeks nonstop. But even before that, we all know the economy was slowing as we headed into the year. Even with that, you know, you think about it, Netflix has in their words, it's always hard to judge this, Melissa, but in their words, they have the strongest content slate in the history of the company. So even in a weak economy, people are spending more time consuming Netflix. There is more iconic content. I mean, look at the success of something like Adolescence, not an expensive show, blew up all around the world. And so creating more content that people love, consumption going up, raising price, not really economically sensitive versus the rest of the media space, and generating tons of cash and increasing their buyback. Like, numbers look low for the rest of the year. Like, this is a pretty great position to be in. And they're literally leaning in and taking advantage of everybody else. I mean, if the ad market slows and TV slows and cord cutting accelerates, Netflix's relative position increases, which is, I think, why you're seeing investors rotate to what I would deem the safer, more predictable names, whether that's Netflix or Spotify, and staying away from the entire traditional media sector, which looks very, very problematic as you look through 25.
So in the spirit, Rich, of trying to find a hole in the story, is there any concern on your part? Okay, well, I'll name what my hole could be, and we can compare, okay? Is there any concern on your part that there could be a tax on services around the world, a tax on content, which could change the economics for Netflix, even if it's temporary?
I mean, look, there's always risks around, levies that could be placed on different companies in different countries.
Well, we're in a world where there's reciprocal tariffs and tariffs on this and tariffs on that, and people are looking, countries are looking for a way to gain some leverage.
Still, you're looking at a company that has an incredible price-value equation. You see the pricing power they've had. So I think at the end of the day, as long as this is placed on everyone, meaning Disney Plus, this is placed on Hulu, this is placed on Max all around the world. Like, as long as that I don't think there's any reason why you would see something on Netflix that wasn't placed on others, Melissa. So I don't think on a relative basis that's a reason to be concerned. And all of these streaming services are still far better values for the money, time spent relative to consumption, relative to the traditional TV ecosystem. And you see that. They're 10% of viewership in the U.S. or, thereabouts. They're now up, I think, 9% in the U.K. So everywhere around the world, they're sort of replicating this model of becoming, roughly 10% of total TV time spent. That gives them a lot of leverage in terms of that price value equation, because it's still pretty cheap entertainment. And the advertising plans, they made a great point. Greg Peters has been really leading the advertising charge. He's co-CEO. And I think that plan, for the first time in a recession, if we go into one, you tell me, or the rest of the Fast Money team tell me, but if we are going into a recession, this will be the first time they're going in with a far cheaper ad-supported plan that really protects them on the downside. Even if people downgrade, they're making just as much money in the standard plan if you downgrade because of the benefit from ad sales. So that's a really good position. My concern is something entirely different.